welcome Mad Money. Welcome to Cramerica. Friends, I'm just trying to make a little money. My job is not just to entertain, but to put it in context, do some teaching here. So call me 1-800-743-CBC, tweet me at Jim Cramer. The fourth year of the bull market begins just as the third ends, with skepticism, with disbelief, and contempt for the bulls. Of course, that's been the hallmark of the entire run, hasn't it? The conventional wisdom says that the true believers are either frauds or mountebanks or morons. People who embarrass themselves every time they do some buying into the dips. Never mind that buying the dips has made investors a lot of money over this run, and so many others in the last 45 years. Now, if you bought my new book, How to Make Money in Any Market, you know that I think contempt is a two-way street. And the real losers in this market are the skeptics who keep missing these phenomenal moves. By the way, that includes today, where the Dow gained 238 points, the S&P advanced 0.533%, NASDAQ climbed 0.52%. Why is that? Why does it mean that you missed something? Because, look, this morning, the market at around 6 a.m., it seemed like it was going to be down 1% from the get-go because of worries about bad loans at banks. But by the time we opened, we heard from a series of banks that were doing fine. And we got a spectacular quarter from American Express. That fueled still one more rally as the anticipated decline predicated on bad bank loans didn't surface. Why do the bears keep being betrayed by the market? I think it's because the pessimists and their buddies in the media tend to lose track of what they're investing in. Not the S&P 500, the index itself, but the companies in it. If you only put your money in index funds, it's hard to see. But once you get your hands dirty with individual stocks, you find that those companies are simply doing way too well to justify such a high level of negativity as you hear about and read about in making money. Which brings me to the game plan for the next week. Chock full of earnings reports that I believe will be much better than expected. On Monday, we hear from Cleveland Cliffs, and we need this steelmaker to tell us if the real economy is still holding up. This may be one that is a little too weak. Remember, there are three economies: the data center economy, the speculative economy, where I see lots of insider selling coming, and the real economy, which is heavily dependent on the Fed cutting rates. Let's see what Cliffs has to say. After the close, speak of the devil, we get results from Zions Bancorp, the regional bank that confirmed J.P. Morgan CEO Jamie Dimon's cockroach theory of bad loans made last week. There's never just one. I want to know how Zions got defrauded bad, but not related to the broader economy. Good. And if we need to find out if they're seeing more weakness, widespread weakness, and they could, I've never really felt they were that good a bank. Tuesday, Coca-Cola and GE Aerospace report. I think Coca-Cola will put up its usual excellent numbers because it is the most consistent of the packaged goods stocks, while GE Aerospace, primary supplier to both Airbus and Boeing, will deliver another upside surprise from all the maintenance it does for these aircraft. Sleeper Dow stock 3M is expected to have a strong but unheralded story. And Charitable Trust Club named Danaher, one of our biggest laggards, may report the first of many good quarters after a shocking multiple-year dry spell for this once incredibly well-run company. After the close, we get results from another investing club number. Oh, boy, is this a controversial one. It's called Capital One. And I have to tell you, I feel emboldened on this one after that terrific American Express quarter. Remember, this is another credit card company. Could be a good one. The first quarter that should take into account the acquisition of Discover. Boy, do I want to be on that call. Wednesday, we've got two data center stories. Vertiv, which cools the red-hot data centers, and GE Vernova, which makes the turbines that power so many of them, gas turbines, I should add. I believe Vertiv will once again deliver an excellent number. Someone put out a sell this week on GE Vernova, and I thought that was absurd. But then again, I wouldn't have bought this one for the trust if I didn't believe it was capable not of a quarter or a year run, but a multi-year move. Wednesday night, Tesla reports, and there's so much that Elon Musk has to say about self-driving and robots that I barely care about car sales. Let's hope Wall Street feels the same. Musk knows the drill. He will dazzle the faithful and explain why the biggest run of any major stock is justified on top of what's already happened. IBM reports too. I expect them to explain why the bears who don't think that the growth rate is up to stuff last quarter will have to eat crow. Hey, by the way, CEO Arvind Krishna has the best quantum computing campaign on earth. It puts all the speculative operators to shame. And unlike something, say, like IONQ, where insiders dumped 6.6 million shares, take advantage of a colossal run based on retail buying, with IBM, you really don't have to worry about a wave of insiders ringing the register. That doesn't happen. Thursday, we find out if the awesome gold rally still has legs when Freeport-McMoran reports. This company has the world's largest gold mine with the world's largest set of gold mine problems, including recent horrendous flooding in Indonesia. But if they talk a good game, precious metal could have still another rally. Next, the street's getting behind T-Mobile again, which may mean that their Apple initiative, they're the most gung-ho about offering a low price for each iPhone iteration, is coming in above the estimates. Be prepared for both stocks to run. Apple looked good today. Honeywell reports too, and this stock feels totally snake-bit. Honeywell's breaking into 3 viable companies, including a pure-play aerospace business that I think is woefully undervalued versus competitors. I'm not saying don't worry about the numbers. I'm saying look through them, because the breakup is coming, and the stock's been hammered. We also get results from Blackstone, and I find the aspersions being cast against private equity to be ridiculous at this point, given how well most of these firms are run. I think we'll see a particularly strong quarter this time, including from Blackstone's sizable data center business. After the close, Ford reports. Look, we got to find out how much damage this gigantic fire at a key aluminum plant will do to their numbers. If the numbers do come down, by the way, I think the stock could slip below 11. We've lacked big picture data of late, of course, because of the shutdown of the government. And the whole exercise of dividing the market's fortunes is a little bit more fraught than usual because of lack of empirical evidence. But we're able to get some data on the consumer when the Bureau of Labor Statistics wakes up and gives us the CPI report on Friday. If we see a number below 3%, it's going to be huge for the market, fully justifying the remarkable decline in Treasury yields, too. Finally, Procter & Gamble reports on Friday. This stock has been a real house of pain until the last 2 days when I started saying that Procter has bottomed. In How to Make Money in Any Market, I spend a lot of time dissecting conference calls, especially the Procter & Gamble conference call, because they're such fabulous explainers. I think they'll give you a terrific one this time, and you'll want to own the stock ahead of time. Here's the bottom line. The bears will hold their nose and hide their eyes and disengage their brains once again as next week progresses, because it should be another good one for earnings. And earnings, not anything else, are what really drive stocks lower, or in this case, higher. Leslie in California. Leslie.
Jim, I'm buying the book for all my friends this Christmas. Jim, I've read.
So I'm betting a lot of people do that, but it's commercial enterprise on my part. How can I help?
Okay. Question. Airbnb. Buy, sell, or hold?
Oh, I like Airbnb. It's chronically being denigrated because people don't feel that the app does well. Therefore, I think it is time to put your money where your mouth is. Airbnb. Remember, earnings are what matter most in the direction of stocks, not the index itself. Keep that in mind next week when the reliable names keep putting up some excellent numbers. Oh, man, tonight. We sat down with the CEO of Elf while we were in San Francisco, and I learned a lot about how this company is still in growth mode, despite tariff headwinds. You don't want to miss that one. Then Salesforce issued guidance at Dreamforce earlier this week that brought the bulls back into the fold. I'm detailing what the company announced and giving you my take on the multiple bear rates against it. And PG&E has rebounded from its lows, so could the move be sustained? Don't miss my exclusive with the company's top brass. We will also talk data centers. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
While I was on the West Coast, I got a chance to check in with Elf Beauty, the value-oriented cosmetics company based in Oakland. Even though this stock's up 9% for the year, it's been a real volatile trader, in part because its heavy reliance on China for manufacturing. But this hasn't done much to derail the stock lately, and I wouldn't be surprised if it's got more upside. Earlier this week, we sat down with Tarang Amin. He's the chairman and CEO of Elf Beauty. To learn more, take a look. It's a very exciting time for your company. When I saw you last, Road had just started. How's it going?
Oh, it's going wonderful. We just recently launched Rhode, the brand we acquired a few months ago, founded by Haley Bieber, into all Sephora North American doors, and it's the biggest launch I've ever seen in their
So
history.
it was everything you said it was going to be.
Absolutely, and more.
And at the same time, one of the reasons I love you is I call it a barbell, is that you've also gone into Dollar General, which people may not realize is an inexpensive, fun place to shop, and they brought you in.
Yeah, that's right. And the thesis there was Dollar General serves the underserved. And so we felt that taking e.l.f. into these rural stores, most of their stores are in communities with less than 20,000 people, we'd be providing the best of beauty to what otherwise was a beauty desert. And so far it's worked great. They couldn't be happier with the expansion of e.l.f. 60% of the people who are buying e.l.f. at Dollar General had never bought cosmetics there before.
Additive. I call that additive. Now you're during quiet period, but that is terrific news. I thought of you the other day when the president had his fit and talked about maybe 100% tariff, and I was saying, oh my God, what will our friends do at e.l.f.? You probably have every single contingency covered at this point, right?
Well, I mean, we just finished our 26th consecutive quarter of net sales and market share gains, and we've done that by really focusing on value. So we have a very balanced playbook. We have pricing actions, supply diversification, business diversification. So we hope for resolution, but we'll be prepared.
Well, one of the things people have to recognize is the gap between you and everyone else is gigantic. And prestige, the gap is kind of insane because how much different are they in terms of what they are made of and what they're doing than you?
Well, I think that's one of the great things about e.l.f. is we take inspiration from our community, the best products in prestige, put our e.l.f. twist on it and introduce it at incredible value. One of my favorite products right now is the vitamin C plus E Ferulic serum. We price it at $17, which is higher than what normal e.l.f. products would cost, but the only other thing like it in the market is $185 serum.
Oh my God.
Yeah.
How are you able to do that? Sourcing? What do you do?
Well, we have a real advantage. I mean, we've been at this for 21 years,
right,
really making the best of beauty accessible. We have an incredible innovation engine, the way that connects to our supply chain. We have the best combination of cost, quality, and speed, and we love delighting our community.
One of the things that shocks me is you open your playbook. For instance, you have perhaps the most exciting online presence of any consumer product company. You said you didn't want to say cosmetic, consumer product. And you just say, listen, it's got to be funny. Okay? Now, there's the playbook. Why isn't anyone else adopting it?
Well, I think it's the speed at which we move. We do about 100 marketing campaigns a year, and it's all driven
100?
Yes, it's all driven.
So you're rolling it.
It's driven by what delights and engages our community. I mean, we recently, just last week, we introduced a mega version of our Power Grip Primer. It's 50 times bigger than our Power Grip Primer, which is the #1 item in all of color cosmetics. We sold it on TikTok Shop. For the same price, we do our regular Power Grip Primer at $11. Sold out in 3 minutes. And we now asked our community, what else do you want on Mega?
3 minutes.
3 minutes.
That's extraordinary. Yeah. People know what you're up to. And I know that because something I get very excited about, and I know people think it's silly that I do, but the Piper Teen Survey has made our viewers a fortune. And sure enough, well, tell them how you finished.
Yeah, well, they issued their semi-annual survey last week. e.l.f. Cosmetics was their #1 brand amongst teens for a record of 8 consecutive surveys. And it's not just e.l.f. Cosmetics. e.l.f. Skin is a top 10 skincare brand amongst teens. Rhode just cracked as top 5 amongst upper income teens. And so we really have an ability of being able to engage and entertain that community, but it's not just teens. We're the #1 brand amongst Gen Alpha, the #1 brand amongst millennials. So this multi-generational appeal, more and more people are coming to e.l.f., and that's one of the reasons why we've grown market share 26 consecutive.
There are more countries that no one would think of that like e.l.f. Again, because you're fun. I mean, it's sure, Britain and Boots, but there's some Central European countries that are crazy about your stuff.
There is. In fact, we were very excited to be introducing e.l.f. into Rossmann's in Poland, following our successful launch with Rossmann's in Germany. But we can also going to be going into Sephora in the GCC. So we have strength across the entire portfolio, and we're expanding our brands all over the world.
Why did this? Do you think it was because of China that the stock had that dip and people thought that you were going to have to raise price by a dramatic amount? Or was it what I told you, which is I just think there's sometimes people want to press your stock down, which revolts me, frankly, because you're a proven great business person. But I could understand a thesis which just says maybe they have to take the price beyond where their core viewers, core audience people can afford.
Well, we take seriously our responsibility to deliver superior consumer value. So even in the face of 55% tariffs, we only took our prices up $1 because we're really conscious of making sure it's a value.
Who ate it? Did you eat it, or were you were able to go bargain back and forth?
Well, I think it's a combination of we want to make sure we have superior value, and the dollar covered the level of tariffs that we're currently seeing.
Again, speaking previous quarter, can't talk about current, but you were able to beat the street, even though you must have had no drop off whatsoever when you raised the price.
Well, I mean, we saw some unit drop off, but overall, we're continuing to grow market share. So more consumers are voting for us.
And you're still taking footage when I go to a different store, or when I go to one of the major discounters. You're going to be bigger and the other guys have less?
It's absolutely happening. At Target this spring, we went to 20 feet of space. We're their #1 brand with over 24% of their category. Walmart took us up to 12 feet of space. I think we're now their #2 brand, but the most productive brand either retailer will carry. Actually, any retailer that carries e.l.f., we sell more per linear foot than any other brand.
Interesting. Now, how about go back what you mentioned about the different Z's and X's. You are dominant in the youngest people too, correct?
That's right. That's right. We have most purchased amongst Gen Alpha. We have a great experience right now on Roblox, the #1 branded experience
on Roblox.
Very
really smart. I'm just always amazed that you know where to go. You go where the buyers are.
Absolutely. Our team, I think a big advantage is our team reflects the communities we serve. And so it's 74% women, 76% Gen Z and millennial, 44% diverse, and they have a real pulse of what our community wants. And there's also zero distance between our C-suite and our community. My CMO sometimes terrorizes me, dragging me onto TikTok Live, and she'll go on and say, all right, you got the big boss now, tell them what you want. And they're not shy to let me know exactly what they want.
Well, I love working. I cannot let you go without talking about something that just happened, which is Change the Board Game. An initiative founded by e.l.f. Beauty grows coalition championing inclusivity on corporate boards. Thank you for not giving up on something that used to be that was very important in this country.
Well, thank you. I mean, we're all about inclusivity. As I just mentioned, our team reflecting our community, but so does our board. Our board, we're one of only 5 public companies in the U.S. with a board with 2/3 women and 44%.
Well, I'm thinking about something. How is it that the most profitable company has the most diversified board? Because it's right.
That's right.
Thank you, Tarek Amin. He's the CEO of e.l.f. Beauty. This is a stock we have back now since it was at $15, and I wish I had been even stronger recommending it. Man, money's back after the break.
Thank you.
Coming up, after 4 days in San Francisco talking with some of tech's top leaders, Cramer's coming home with one big takeaway on Salesforce. He reveals it next.
We just got back from an action-packed 4 days in San Francisco, where I spent most of my time covering Dreamforce, which is Salesforce's annual user conference. It's become a festival for all things tech and AI. That's why I did the show direct from Dreamforce on Tuesday. And we heard a lot from Salesforce CEO Mark Benioff about the success of Agentforce. That's their AI platform that uses digital agents to more or less replace humans. But on Wednesday night after the market closed, we got some very big news from Salesforce itself. See, every year on the sidelines of this conference, the company holds an investor day and an analyst session where they talk numbers, give you an outlook. And this time, whoa, the stakes were so high. Remember, Salesforce, this stock has been a real dog this year, like virtually every other enterprise software play, though. Going into that analyst meeting, it was down 29% year to date. That's highly unusual for me to remember that stock be that bad. It is a holding of our charitable trust. The entire enterprise software industry is under pressure from the somewhat nebulous threat of generative AI platforms, which have proven to be quite adept at writing code, to the point where potential clients may just make their own software using AI instead of using, say, Salesforce. Now, if AI leads to layoffs, that hurts Salesforce too, because they typically charge based on the number of users at a given organization. It's called the seat model. But at a more basic level, Wall Street's simply not sold on the idea that Salesforce's AI business, Agentforce, is truly working. Salesforce rolled out Agentforce late last summer and in fairly short order put the whole weight of the company behind it. I can speak with Mark Benioff fairly often, and for over a year now, always wanted to talk about is Agentforce, even though it was clear from the analyst meeting that it wasn't really ready for prime time. In the meantime, though, we haven't seen a meaningful pickup in Salesforce's revenue growth from Agentforce. Don't get me wrong. The company's reported some very solid quarters. It's not like the business is doing badly. But they're spending a lot on this Agentics platform, and so far we just don't know if it's going to pay off. Keep in mind, Salesforce has been one of the great growth stories of the past 20 years. In 2005, they did about $300 million in revenue. This year, they're on track to do north of $41 billion in revenue. That's amazing. Yet for the past 5 quarters, Salesforce's stock has been stuck with it, and that's because the company has a revenue growth rate in the high single digits. Not terrible, but definitely not what Wall Street hopes for from this kind of growth company. Some of us have been questioning if Salesforce is still a growth company. So considering all the enthusiasm about Agentforce from Benioff and his team, I've been hoping to see that growth rate move higher. And it simply hasn't. It's been stuck in that 8-9% range for the past 5 quarters. And that's why the stock has done, well, you can see that, huh? Nothing. And that bothers me tremendously. Sorry. But that brings us to the Salesforce investor and analyst event on Wednesday night. The session began with a deep dive into Agentforce, but rather than focusing on how it can help customers, management went into detail on how the company has become adept at pushing Agentforce to the point where it's bringing more business for Salesforce overall. And it gave us these really convincing examples. A consumer goods company that grew its spend by 50% after adopting Agentforce. A consumer electronics company that quadrupled its spending with Salesforce after embracing Agentforce. In other words, they weren't cutting back on spending. They were giving them more money. More importantly, management rolled out some new long-term guidance, which was very reassuring to investors. The headline was a new revenue target for 2030 fiscal year, more than $60 billion, which was huge. Why? 2 reasons. First, the 2030 revenue target was better than expected. Going into the meeting, the analysts were expecting $58.4 billion in revenue for the 2030 fiscal year, which is more like the 2029 calendar year. So that's meaningfully higher than expected. Second, and perhaps more importantly, Salesforce's $60 billion target implies that the revenue will rise at a compound annual growth rate of 10% over the next 4 years or so. Again, Wall Street's been frustrated because the company's revenue has been stuck in the high single digits. But now Salesforce is implying that their growth will reaccelerate to the low double digits for an extended period of time. Maybe also that could be an under-promise, over-deliver situation. It's a huge development. And it's why the stock jumped 4% on Thursday. At one point, it's up about 5% for its single best day gain since May. Didn't hurt that Salesforce also committed to buying back $7 billion worth of stock. That's roughly 3% of the shares outstanding over the next 6 months. Management also said they expect to be a Rule of 50 company by fiscal 2030, meaning the revenue growth plus their operating margin would add up to more than 50. And it's the higher quality version of the Rule of 40 that we often talk about when it comes to enterprise software stock. Now, look, this would be a huge feat to pull off, and I think it will be. So we are sticking with the stock, which you can learn more about in reading my weekend bulletin that I put out Sunday night just for subscribers to, yes, our investing club. Now, of course, this isn't actual evidence of Salesforce making a comeback. As the great Frank Slootman, formerly of ServiceNow and Snowflake, once said on this show, the guidance is the guidance. It's more of a sign of management's confidence in the future. Not everybody shares that confidence. Almost immediately after the fiscal 2030 revenue targets was issued, we heard from the skeptics, the bears, the people who really are trying to control the stock, impact players like D.A. Davis's analyst Gil Luria, who called the target, quote, aspirational, end quote, and said, quote, we are not ready to underwrite a reacceleration to a 10% plus organic growth CAGR, compound annual growth rate through 2030, end quote. Oh, in other words, he thinks that these companies are making it up, I felt. The onus is now, or dreamers, the onus is now on Benioff and Salesforce to deliver against this lofty revenue projection, and the proof will be in the proverbial pudding. Still, for me, the mere announcement of this ambitious revenue target felt like a turning point for Salesforce. As an extremely frustrated long-term shareholder in this one, it was very encouraging to finally get a break from what's felt like a constant drumbeat of negativity this year, at least from the analysts. Bottom line, after spending the week in San Francisco, much of that time at Dreamforce, I'm feeling a lot more sanguine about Salesforce's stock than I was last Friday. That said, if you want to own Salesforce, you need to have faith in Mark Benioff's ability to deliver on the long-term targets. Given his track record, his long-term track record, call me a believer, which is why we still own this one for the Charitable Trust. At the same time, patience is needed. Even though Salesforce's new long-term guidance was positive, the enterprise software group is so hated, I don't know if anyone on Wall Street will even care. At least for the moment. I don't know if the stock can snap back anytime soon. I'm simply betting that it'll be a winner over the next 12 to 18 months, which means you can't afford to trade in and out of it, because when you do that, there's a very good chance that you're out of it when we get the eventual gains. I want to take some calls, and therefore I want to go to Gary in Alabama. Gary.
Hey, Jim. First of all, I have to thank you for the invite to New York a couple of weeks ago. That was really special. It was great.
Wasn't that great? That was what we call one of the perks of being a member of the CNBC Investing Club. People should watch.
Absolutely.
It's not a static thing. I throw the world at this thing. So does Jeff Marks. You'd be nuts not to subscribe. How can I help?
I know, it's fantastic. Thank you so much for all your help.
Of course.
Well, I'm a big fan of Meta. I have bought that stock off and on over the years and have made good money with it, but it's been bouncing around a lot lately. So a two-part question. First, do you think it's a good buy at this price? And secondly, what do you think the chances are of a split in the near future?
All right, I'm going to answer the latter first by saying I have no concept whether Mark Zuckerberg wants to do a split, but he sure does want to exceed. And having a 24 multiple on next year's earnings, which I calculate, is an insult to this man to have a market multiple. I expect the stock, which is off 80 points from its high, to have a very big run here, and I urge you to stay in it. And by the way, I also thank you for the kind words about the club when we brought Jensen Huang to members of the club only. Salesforce's new revenue target feels like a turning point for the company, and I'm definitely more encouraged about their outlook now than I was before the week started. Then money ahead, what do we got? California utility PG&E could be a big player in the data center buildup, but nobody's talking about it. I'm hearing about the projects the company has in the pipeline for CO. And investors don't seem to understand that turnarounds take time, for heaven's sake. I'm detailing the action in Starbucks and Nike and why I'm sticking by these stories for the Travel Trust. Of course, all your calls, rapid fire, in tonight's edition of the Lightning Round. So stay with Cramer. For the most part, this has been a great year for the electric utilities, with a few glaring exceptions. Take PG&E, which is based in Central and Northern California. Its stock is down more than 18% for the year. That's in part due to misplaced perceptions about wildfires. I think this one could be a bargain. Don't take it from me. While I was at the West Coast earlier this week, we checked in with Patty Poppy, the CEO of PG&E. I want you to take a look. Patty, I've got to tell you, I've always been concerned about the unlimited liability that your utilities had, and it's kept me from saying bye. But you seem to have taken care of it since I've seen you.
Yeah, look, our legislature took action. They know that wildfire in California is a risk, and they know they need the investor-owned utilities to be part of delivering clean energy goals and keeping the state safe. Therefore, the legislature took action which capped our liabilities in the event of a wildfire caused from our equipment, which is not necessarily a predictable outcome because we've made our system safer, but that cap has actually been set on a date that actually backdates the date of the risk, and that lowers the risk to investors by billions of dollars.
Well, are people just worried about the $2.9 billion that you have to pay? I thought that was going to be something that everyone knew you were going to have to pay.
Yeah, look, what we agreed to in that $2.9 billion of securitized infrastructure investment is that's to reduce wildfire risk. That's in our mutual interest. That allowed us to do that work for less for customers, and we're all about affordability for our customers.
All right, so if you're able to do that, to get that cap, you're not going to have to issue stock until, I don't know, you took it off the table until 2030. I'm frankly surprised that this stock is still where it is.
Well, I might be surprised about that too, Jim. So, look, I can understand from afar it seems like the risks are high, but what's most important is the physical risk on our system has never been lower. We have consistently lowered risk. We've buried our 1,000th mile of power lines, and we did that at $1 million a mile less than when we started. So we're lowering the cost to make the system safer. We've got AI-enabled cameras that alert first responders so they can be on
For
site.
Blackhawks, huh?
Yeah, we've got Blackhawks. Look, we have an incredibly technology-enabled, safe system for our customers and for investors, because those investors are protected by the AB 1054 construct and the wildfire fund that was extended with that.
I think we're all pretty glib about Diablo Canyon. I mean, I thought it was fantastic that you got 20 more years. I was afraid that these are the years that it's closing. 25, 26, I expect it to be done.
Well, yes, the state extended the plant by 5 years.
But the
though
NRC
the NRC has given us permission to operate. And so now the state will have to take action in 26 or 27 to decide what to do. But look, California's growth is real. We have data center growth. We're up to 10 gigawatts of new applications for growth on our grid. We're going to need clean, resilient, dispatchable, and 24/7 power. It's hard to imagine doing that without Diablo Canyon.
Okay, well, I spoke to Hawk Tan yesterday from Broadcom, and he's a hard-nosed business person. He made me feel like that there could be more power around than I think, because I've been listening to what the hyperscalers have been saying, and like people are just saying, oh, forget it. Larry Fink this morning, who is so good from BlackRock, was talking about, look, we're going to have enough money to be able to have that infrastructure. It's going to happen. You're the first person who made me feel like, you know what? There could be a building boom that is needed, 73 billion in capital, that made it so maybe I don't have to think that we're going to run out of clean energy, data center energy.
Yeah, for sure. Look, we have our 10 gigawatts of applications could result in a reduction in all customers' rates of 10% because the grid is underutilized. Our grid is utilized actually about 45%, Jim. That means that excess utilization, when we utilize the grid more, rates go down for everyone. This boom of AI right here in California, Silicon Valley, my goodness, I serve all of these tech companies. They're growing here. We get to grow with them. We get to power them and lower rates while we do.
Okay, then why are people still trying to bid? Yeah, I know power's low, cheap, Maryland, Virginia, whatever. But a lot of those states don't have any room. They're tapped out. And yet you right here have room.
Yeah, people were confused about that. Frankly,
Yeah,
our
they are.
customers.
Please explain it.
Our customers were confused. They thought we were out of power in California. We've been adding capacity. In the last 4 years, California has added almost 20 gigawatts of new capacity to serve. We've been staying ahead of it. You know, there's a lot of things that people think about California, but one thing that's working, the CAISO, the independent system operator here in California, works. They direct the infrastructure to be built, and we build it. The state has been building infrastructure. That infrastructure is ready to serve.
Now, is some of it because, sadly, I would tell you that we seem to have slowed down with EVs in this country?
Yeah, not here.
Right, they're still buying them
Yes,
here,
we're still buying them here.
There's 49 states that they're not.
Yes.
And there's one that is. Okay.
But the good news about EVs, for every million EVs we add to the grid, that's another % reduction in rates. Let me just tell you this, Jim. In the face of national rate pressure for electric customers, our rates are down. Our rates will have dropped 3 times, in fact 4 times by the end of this year from 2024. So our rates are down this year, and they're scheduled to go down again next year. We have implemented our lean operating system. The simple, affordable model is at work at PG&E. We're able to grow California, make it cleaner, and reduce rates.
Then explain to me why there are so many utility companies that say, hey, if it weren't for the data centers, your bill wouldn't have gone up. Those people are dissembling. Those people don't know how to run an maybe they don't know how to run a utility.
All I know is our facts here, and our facts on the ground are...
Come on,
Technology can enable growth, and that growth can lower rates for customers. You have to do it right. You have to have a smart grid, and you have to have a grid that is underutilized, which ours is.
And you are still shooting for net zero energy by 2040?
Yes, we are.
How is that possible? You've got a good pastiche right now.
We do. The energy that we delivered to our customers last year was 98% GHG free. It helps to have a large hydro system, which we have.
Right.
It helps to have Diablo Canyon, which we have. In fact, I was there yesterday with the team. They're in a refueling outage, never been better, working hard, making sure that that plant is available to run if the state so calls us.
Okay, can you add another plant there? We know that the NRC is looking positively if you do that.
Well, today it would be illegal in California to add a nuclear plant. I will say the plant was designed for 6 units.
So you're not going to, you can't reopen Rancho Seco.
Look, Diablo Canyon is a perfect place for California.
I totally agree, and I'm thrilled that it took 20 years to build, and it probably will cost even more now if you had to build it. So the last thing I wanted to ask you about is actually about fire. Mm-hmm. How can they cap you when it's? How can we not be sure with climate change that it's just not going to get worse and worse? I think you and I share the idea that there is such a thing as climate change.
Yes, we do. We do. And extreme weather as a result of that is real for us.
Okay.
We're living it, we experience it, but
And they put homes right next to the toughest areas.
yes, but homes can be hard, and I actually think that's the next step for California. Look, we have continued to make our system safe. It's never been safer. We're not done yet.
Right.
We're going to keep making it safer. We've deployed sensor technology this year that predicts failures. We use our smart meters to indicate faults on secondary lines. That has provided significant advance warning of risks on our system. Then we're partnered with, of course, CAL FIRE, the best in the business fire response. So on those two bookends, there's a middle layer here that our communities are not yet hardened enough. We have to prevent the spread of fire, and that can come from building codes, that can come from community partnerships. Communities like Marin, not far from here, just across the Golden Gate Bridge, they're a fire-wise community, and they've put in the defensible spaces, and they've taken measures to train and coach residents to make their individual premises safe, their homes safe. People in California do not need to choose between having power and being safe. Our infrastructure investments, burying the power lines, is the cheapest form of making those communities safe, and we're committed to continuing to do that at the lowest cost.
Well, let's leave it right there because you've been phenomenal at doing that. No one thought that this could be pulled off, and well, I did, frankly, because I remember what you did in your previous employ. This Patty Poppy, PG&E CEO. Look, if the liability's capped, I don't know how you not buy this one. Thank you so much.
Thanks, Jim.
Coming up, lightning doesn't just strike twice in Cramerica.
Booyah, Jimmy Chill. Booyah, booyah, booyah.
Thanks for taking my call.
It strikes every day. Cramer is back in a flash with your questions. Next.
It is time. It's time for the lightning round. Quick fast from Ralph Gordon over me. Same as Dr. About my social internal content, my separate. And then the lightning round is over. Are you ready, Ski Dad? Time for the lightning round. Let's start with Nick in North Carolina. Nick.
Booyah, Jim. Happy Friday.
Same to you, partner. What's happening?
Hey, look, after having a great third quarter, I wanted to get your thoughts on Carnival Corporation.
I'm a buyer of Carnival. Let me throw in that I like Royal, too. Hey, how about we go to Ian in Florida? Ian.
Booyah, Jim. How you doing?
Oh, man, having a good day. How about you?
Excellent. Absolutely excellent. Jim, I'm a fourth-time caller, long-time listener.
All right.
And I wanted to ask you today about kind of that one spec like you talk about. It is a Bitcoin miner / getting into the energy data center move. It's Iron.
Oh, no, Iron, let me tell you something. You are going to sell Iron. I'm going to throw another one in. I'm going to give you two for the sell side. Nebius. I am looking for insider selling to descend upon this group, and I will not be wrong. I will not be denied. I sense that. I'm trying to get people out ahead, and IONQ has already demonstrated my perspicacity. Take that. And let's go to Ted in New Mexico. Ted.
Hey there, Jim. Ted, New Mexico. C3AI dropped about 40% in August.
Well, you're getting an opportunity. I can't stop it. I don't know what's the matter. Okay, and that, ladies and gentlemen, of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, Starbucks got a real jolt this week. It's best since Brian Niccol was named CEO. Cramer is pouring over the stock and revealing if it's a brew you can believe in. Next.
Booyah for the Emperor of Cramerica.
Honorable James J. Cramer.
You got me jumping around my office right now.
Thank you so much for all you do for us.
I enjoy your show, and I find it very entertaining and informative.
I watched your first ever episode of Mad Money back in 2005, and I've been watching every single episode ever since.
Don't miss Mad Money every night at 6 p.m. Eastern. Plus, join the CNBC Investing Club and stick with Cramer around the clock.
I love turnaround stories, but good turnarounds take time, and a lot of people give up about 6 to 18 months in when they realize it's not going to happen immediately. You can see that right now in Starbucks and Nike. I'm getting the sense that many of you believe that neither Elliott Hill nor Brian Niccol is up to the task of saving their companies from the throes of failure. But all that does is make me want to double down for my charitable trust. Let me tell you why. Earlier this week, I met with Brian Niccol from Starbucks, who spoke at Dreamforce with Salesforce's Mark Benya. When it was announced that Brian, who just turned around Chipotle, would become Starbucks CEO, that stock was in the mid-70s. It instantly jumped to almost 20 points in the news, and over the next 7 months, the stock worked its way to $117 as it became clear that he was the right man for the job. Buyers pushed it up like crazy, and the analysts did nothing to discourage them, which is why it was so painful that the stock came right back down to $78 before its recent run to 85 and change. I know Brian. He knew that I loved Starbucks, the stores, and that they had gone downhill. He knew I respected his work at Chipotle, where I had always had an open dialogue with him. Brian never encouraged me to be as bullish as the analysts were. He emphasized endlessly that the turn would take time. I don't think he knew things were as broken as they were. That's not unusual. New outside CEOs usually can't see into the organization. They don't recognize the rot. What Brian ultimately found was that the whole Starbucks story was based on having fewer people working and a reliance on technology to do the job. Dumb for any successful fast casual performer. It was a slippery slope that led to a crash. Some analysts now blame the stock's latest downturn on the slowness of the turn itself. I blame the decline on the lack of recognition from the analyst community that Brian wasn't playing U-Pot. He wasn't under-promising in order to over-deliver. Starbucks was in no shape to promise anything because the entire organization had just been a wreck. Now, at last, I think Brian has his arms around what's been going wrong. He knows that staffing, not technology, is the answer. He recognizes that not all the stores can be kept open because their layout doesn't allow for a third-place transformation. I see the analysts turning against him, though, largely because they got ahead of themselves. And that tells me it is time to buy Starbucks, not to sell it. Sell. Same deal with Nike. The previous CEO took a good company and turned it into an also-ran. He had a strategy, turned Nike into a direct-to-consumer business with the best tech. Again with the tech, and business will turn around. First, there was no need to turn. The guy inherited a good company. Second, shoes need to be tried on, which makes digital problematic. Hey, by the way, it doesn't help that when Nikes are delivered to your doorstep, they often get stolen. Now that Nike old hand Elliott Hill has come in, he needs to reinvent the entire business. First, he needs to go back to the old brick-and-mortar distribution network, including Foot Locker, which is now part of Dick's. Second, he can't just go into the locker and pick out old Nikes to reintroduce. It means new science and innovation have to be developed, which seems to have been obliterated under the previous regime. Third, he has to fix China, not a quick fix. Oh, and let me just tell you, there's still inventory in the system, and that holds down earnings. But most important, he's got management and the rank and file rowing in the same direction because he was much loved before he left. You spent any time with him as I have, and you know that's the case. This is another stock, though, that's been pulling back as analysts realize that the fast turnaround is impossible. Again, they don't seem to understand that turnarounds do take a lot of time. This is precisely the moment when people want to give up on Starbucks and on Nike, which is why I want to be a buyer, not a seller. Buy of both. I like to say there's always more somewhere. I promise to find it just for you right here on Mad Money. I'm Jim Cramer. I'll see you Monday.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.